Hello, everyone, and welcome to our How to Manage Your Startup Equity event. My name is Ryan Micheletti, and I'm head of global operations for the Founder Institute. As most of you know, the Founder Institute is the world's largest pre-seed startup accelerator. We've helped launch over 5,000 companies across 200 cities with the largest mentor network in the world of 21,000 mentors. We also created a program called VC Lab that is launching hundreds of new venture capital firms all over the world to increase funding activity and access for founders that are going through the program. And so part of my role at Founder Institute is to work with these startup leaders and founders that are going through our programs all over the world to help make sure that we're building impactful global startups. And so I also run the Founder Institute Silicon Valley Accelerator. If you're interested in applying, you can look at all of our enrolling chapters across 6 continents by going to fi.co/enrolling. And so for the topic today, most founders can be easily overwhelmed when it comes to properly managing startup equity. But it is essential, and it's important to get that right, because especially during due diligence with investors, when it comes to recruiting top talent, it's not just about managing the equity, but it's also about how do you allocate equity to co-founders and to people on your team? And so the event today is the 3rd event in our Mastering Startup Operations series featuring my good friend Adam here. And we're going to be discussing best practices for early stage startup equity, how to create and manage cap tables, what pitfalls to avoid, and more. And so we have a great international audience today. Be sure to say hi in the chat. Let us know where you're from. And if you're working on a startup, would love to see what you're working on. So the agenda for today is we'll do a presentation on startup equity. We'll do some introductions with the mentors here. And then what we want to do is, instead of doing Q&A at the very end of the event, we want to go slide by slide and kind of do active Q&A. And so if at any point you have questions in the chat, go ahead and put it into the chat. Our team will send it over to me, and then we'll ask Adam and Neil here on a slide-by-slide basis. And so after the event today, we have a post-event social, a networking event on AirMeet, where founders who are joining us today can network with other founders, network with the mentors and the people who are here at the event to talk about startups and best practices. So if you're interested in meeting with other founders, recruiting co-founders, those sorts of things, be sure to stick around for our networking event after the session on AirMeet. So without further ado, it's my pleasure to introduce Adam Spector. Adam, I've really enjoyed these series that we've been doing. Why don't you give a quick overview of yourself and what you're working on?
Yeah, absolutely. Thank you, Ryan. So I'm the co-founder of AbstractOps, and our main focus is pretty simple, which is we want every single startup in the world to have the best sort of back office operation possible. The simple fact is that every single founder on this call today, you have presumably, a great product idea that you believe needs to exist in the world. You then need to go get that product into the hands of your customers. So those are the 2 key pillars of the startup. But then suddenly there's this 3rd part where you actually have to kind of run your business, right? And you have to deal with things like equity, HR, legal, compliance, regulatory, in HR, I think maybe said HR, but like all these different key pieces that you have to end up dealing with to really run that business. And it's really tough. There's no information out there. There's no products or tools to help you automate that. So we're working to automate and reduce the pain of the back office so founders can get back to doing what they do best. And what we actually work on is we actually really work with a ton of amazing partners to help make the back office that much better. And one of those is Pulley, a company that we love. And so I'll let Neil introduce himself as well.
Thanks, Adam. Hi, everyone. I am Neil. I work at Pulley, which is a cap table solution for particularly targeted toward hypergrowth early stage startups. And so like Adam mentioned, one of the probably most painful parts of running a startup is literally everything else beyond product market fit. And that is the stuff that is often the hardest to figure out. You have to go to lawyers, you have to go to accountants, you have to go to other people, and you have to wait for them to do literally anything. And so at Pulley, the mission is that we're trying to enable everyone to be founders. And one way to do that is to destroy all those barriers to entry. And probably one of the most complicated for us is how do you manage equity, the sort of key ownership asset in your business. And Pulley has developed a bunch of tools like fundraising modeling tools, offer letter tools to really sell the impact that equity has on you and your employees. Fundamentally, equity is used to hire and attract great talent and find great investors. And Pulley builds a bunch of products to help you do that seamlessly without a bunch of operational overhead.
Awesome. Well, so let's go ahead and get started with the presentation. Adam, I'll turn it over to you, and then I'll monitor the chat and ask you questions as we go.
Excellent. Thanks, Ryan. So here's the kind of the key areas that we are going to cover today for everybody. But really, what is equity? Why does it matter? Founder equity, which is super critical, especially for a lot of the early stage companies that I know Founder Institute works with. Investor equity, and why do investors care, and how does that all play into things? And then employee equity, because that's also really, really critical. At a high level, the key idea though of equity and what's really important is to think about it's a way to help everybody in the ecosystem related to your business deal with kind of the risk reward trade-offs that you have to make as a founder. And as teammates or investors, everyone else involved, equity is essentially that way to make a little bit more equal or add some really equity around what's happening in the business itself. Like that's kind of the high level idea of what equity is. And obviously the way it comes out, it really varies by group. So let's dive into it. So I'll hand it over to you.
So big picture, what is equity? Equity is your unit of ownership. So if you have equity in a business, that means you own part of that business. And what does that actually even mean? What does owning a business get you? And so there's two big themes going on here. One is money, economics, and two is control. And so economics is probably what most people think of when they think of equity. This is, hey, I bought some Apple stock on Robinhood. I sold it for a higher price. I made some money. That is essentially what's happening with their startup equity. You're getting the equity because you founded the company when it's almost worthless. And then you're going to grow that equity as the business grows over time, and you're going to get rewarded for it when you sell the business or you IPO. That's the same thing that's happening to your investors. They're buying your company at a particular price. When you exit in a couple of years, they'll get rewarded for taking the risk and funding you. And the same thing for your employees. They're working for you, and they'll be working and getting a cheap price on their stock. When you sell or IPO in the future, they'll get rewarded financially. And so that's probably the 80% of what people mostly care about. But the part that gets founders in trouble is often the second element, control. And so one of the sort of unappreciated parts of equity is that it really decides who gets to decide the direction of the business going forward. And so the way a company is structured is that you have shareholders, everyone who owns equity in a company, and those shareholders are responsible for choosing a board of directors. So when you're a new founder and it's say you're a solo founder and you own the entire company, you're the only shareholder, you're the only board member, and you can make yourself CEO. But if you have a bunch of investors getting in on the company, now you don't own the majority of the company, and you have to work with investors to come up with a board of directors. Often you'll still be included, but you may add investors to it, you may add advisors to it, and so on. And at some point, if the board can outnumber you, they can pick a different CEO. This happens typically at much later stages of business development, where you're about to IPO and the board decides they want a CEO that's done this before, things like that. But the thing that matters for you guys as early stage founders is that if you invest in optimizing your equity early, you can maintain control longer. So every percentage point matters, every little detail in equity. If you get that right today, then you don't have to worry about 3 or 4 or 5 years from now getting replaced as CEO or someone else deciding what to do with your business.
In Neil, I think like one thing that probably is underappreciated as well is the idea that there's kind of a trade-off between the economics and control. So in other words, and tell me if you agree with this, right? But the idea being that, look, when you have 100% ownership of your company, the economics might be that your company might be worth kind of zero in a sense, right? Like you own 100%, but it's worth zero. But then as the value of your company increases, so the economics get better, your control diminishes because you're giving away pieces of that company as well. Now, for most people, not everybody, but for most people, at least for me, I would rather own 10% of something that's worth $1 billion than 100% of something that's worth zero. But that's me. But I don't know like how investor or how startup founders should really think through the trade-offs between the economics and control.
Yeah, the way I would think about it is the trade-off is essentially growth. How fast do you want this to grow? There's plenty of companies that bootstrap, which means they're not taking outside capital. They're just whatever profits they make from their product, they're reinvesting in the business, and they're just going at it alone, which is perfectly fine. But the consequence of that is that you're going to grow much, much slower. One of the last deals I did when I was in practice was this multi-billion-dollar buyout, and it was a bootstrap company. It took him 25 years to get to $1 billion, which is totally fine. And he's the founder is super thrilled with it. But at the same time, if you decided to make the trade-off and give away some of your control for, say, VC dollars, you can accelerate that growth dramatically. Instead of getting to $1 billion in 25 years, you can get to in 5. And so that's really what you're optimizing for, is how quickly do you want to grow? The quicker you want to grow, the more money you'll need. And the more money you'll need, the more of your company you need to give away. And so that's really the fulcrum you can use. And part of the sort of growth story depends on your business too, right? Like how much money are you able to pour on top of it to make it grow faster? And that's sort of the key part of finding product market fit, is like, how can I make a repeatable process that I can just throw money at and continue to grow the business so that I can do something when I raise a bunch of money.
Yeah. So I'll pause really quick. Are there any questions? I mean, this is sort of high level stuff, but at the same time, it's also important to understand really these trade-offs. And as a founder, how important it is to take that into account, and what do your investors want and what do you want? And that really will lead into the returns that everyone expects. Like, once again, owning 100% 25 years later is great, but there's a good argument to be made that I would rather own 10% within 5 years of something that's $1 billion, because then I can reinvest that capital in other places, which has real value as well, and really diversifying, if anything else. But I don't know, Ryan, any questions about this, or we can keep moving on?
There's a couple questions here in the chat. It's not specifically about the economics in control, except for one. So Travis, we'll get to your question a little bit later. It's very specific to you. But for Yash, he's asking, what equity should a first-time founder expect or aim to give up during their seed and subsequently Series A? So if we're going to talk a little bit more about like equity distribution, maybe let's wait and then we'll jump into that.
Perfect. Yeah, and we'll dive into that for sure. So we'll get back. Okay. We'll get to the question. So on that note, there we go. Slow to load. Sorry. This is yours as well. Sorry.
Yeah. So one of the confusing parts of equity is that there are different types of equity. So equity is just this big umbrella term for, call it ownership in a company, but the units of that ownership are called different things. There's common stock, there's preferred stock, there's options, restricted stock, and we'll get into all of these later on. But at a high level, the way we like to break it down is, what type of equity do each bucket of people have? Like, what should founders be concerned about? What should investors be concerned about? And what should employees be concerned about? These are your three, call it, personas that are involved in your equity ecosystem. So for founders, the main decision is common stock versus what's called founder preferred stock. And so common stock is your standard cookie cutter fundamental unit of equity. This is what you're buying when you're buying something on Robinhood or through your broker on the stock exchange. You're buying common stock in a publicly traded company. And so for founders, what that means is common stock in the new company you just created. Founder preferred stock is an option that many lawyers will give you, or many incorporation services will give you, as a choice that you can make. And what it amounts to is that you're paying a little more money up front to buy stock in your company, but you're going to be able to sell it to investors in one of your early financing rounds to get some money out of it sooner. And so we can talk about preferred stock in depth a little bit more, but call it 90% of founders we see just do regular common stock, stick to the basics. And that's generally one of our recommendations to new founders is everyone's done this before. The problem has been solved. Every big company that has, reached like 100 billion market cap on the public stock exchange, like Airbnb, has gone through this series of events, and everyone's sort of figured out that common stock to early stage founders is just the easiest thing to do. So investors, they invest in a security called preferred stock. So what does preferred stock mean? It's called preferred because if the company goes bankrupt or sells for less than the investor invested, then the investor gets their money back. And so a good example is, say the investor invested $5 million in your business and you sell the business for $3 million. The investor gets that entire $3 million back because they have preferred stock. And then this can get much more complicated as you get to the later stage. But for your purposes, what you should pay attention to is how much is the investor investing, such that that's like my minimum amount of exit value that I need to get to start making money for myself and for my employees. And so, if investors give you $10 million, you know that if you sell for anything less than 10, you're getting nothing. Your employees are getting nothing. But if you sell for 20, then the investors get the first 10, then you guys get the next 10. And so keep that in mind as you're taking on investor capital. That is what investors are getting in return for taking the risk of funding you, is that if something goes wrong, they get their money back first. And then
Yeah,
for
I have a
employee,
quick question for you about that
yeah.
too. Do you think it's some people might say like, hey, it seems unfair that I'm taking all this risk as a founder to jump in and go build a company from scratch, do all these things, and then investors get all their money back first. What would you kind of say to that from a risk reward perspective?
Yeah, so it's a good question. It's really about information asymmetry. So investors are giving you money, but they don't know your business. They do some diligence, they learn about it, they create beliefs about your market and your product, but they don't know it as well as you do. You're sort of the ultimate arbiter of like what happens in your business, where you think this business will go. And so investors are taking sort of a blind shot in the dark, like especially at the early stage when you're just pitching, where you're pitching a deck, you don't have a product yet, you don't have revenue yet, you're just pitching an idea. Investors look at your idea, like whether this makes sense to them or not, they'll decide to invest, and that's a risk they're taking. And so you as a founder may have this strong conviction that, it's like Airbnb, like people are going to start sleeping in each other's homes in the future when they travel. That is something you believe in, but investors sounds crazy to them. And so they want something in return for taking on the risk of giving you their money sort of with a blindfold on.
Well, in founders, I guess, are also the other thing I would say for founders is you're also getting a salary. Hopefully in most cases, once you're raising a decent amount of money, you're also getting a salary. So you are sort of getting cash out, even if it's not the big returns you might expect if things don't go quite as well as you hope.
Yeah, and one other thing to point out about investors that's useful to keep in mind is that if you're raising from a fund, it's not it's not Sequoia's money that you're investing. Sequoia has investors, and so it's a bunch of other people's money that you're getting when you take on investment from a fund. And so they have an interest in making sure their investors are happy. And so that's why they're very careful about all this stuff, right? Like the ultimate investors for most of your companies are things like pension funds or insurance companies, not, Sequoia or A16 or something like that. And so that's another element for why they feel like they need to get rewarded for this risk and get protected against the risk.
So there is one question here, and it is pretty simple. But Ashan is asking, what's the technical difference between shares and equity?
So shares are just a subset of equity. It's like if equity has there's 10 different types of equity. Shares are just one of those. It's the most common, and it's what you're going to see probably 90% of the time. And at the end of the day, everything converts into shares. We can talk more about what that means, but at the end of the day, shares are what everything is intended to become. So preferred stock is a good example. When you go to sell your company and an investor has preferred stock, they're converting that preferred stock into common stock or common shares. So they're just converting into shares and then selling it. And so at the end of the day, shares are your fundamental unit, and equity is just the broad term.
And that may be a good transition, Neil, into if you want to talk a little bit about stock options versus RSAs versus ISOs and NSOs, and how about that stuff too, because it can be fairly confusing, those terms.
So employee equity is this whole other bucket of equity, because you don't want your employees from day one owning something, so owning part of your business. And then there's many reasons for that. Part of it is sort of the transient nature of employees; they can come and go. The other part of it is that you are the founder; you control everything about the business. If you're giving up sort of common stock to your employees without any other special restrictions, then they're sort of in the same boat as you, which is a little odd. And so the way the industry has sort of evolved to give employees equity is that probably the biggest, there's three big types of them. So the stock options, which you may have heard about before. There's restricted stock awards, and then there's restricted stock units. Excuse me. And those are all just instruments designed to ultimately convert into shares or common stock, but they have a bunch of restrictions and a bunch of interesting tax implications. And we can talk about those as well. But the bottom line is that most companies use options. So call it 75 or 80% of early stage startups use stock options because people have decided that they're most simple. A stock option is very simply, you're giving an employee the ability to buy your stock at a lower price sometime in the future. And so they don't have to pay any money up front. They sort of get this piece of paper that says like, hey, in the future, even if my stock is worth $10 a share, you can buy it at $1 a share. And what that gets you is that employees can buy it at $1 and immediately sell at 10. So they make that difference, which is a ton of money for them. But the benefit is that they don't have to pay any money up front. Restricted stock awards are sort of the opposite. You give employees stock up front, they pay for it, And then if they leave, you have to buy it back from them. And so it's just a very different version of doing that. And we can talk about the ins and outs of why you do that a little later on. But fundamentally, those are the two big options for early stage startups. And then within stock options, and you can sort of see a hierarchy forming here. It's like equity, and then one type of equity is stock options. And then there's two types of stock options. And those are ISOs and NSOs. And really the only difference is in how they're taxed for your employees. And we'll talk about that more in the employee section. But just know that generally this theme that you're going to see here is that a lot of this is about taxes and how you optimize on taxes, which is why it gets really confusing on the equity side. And then in late stage, when you get to say your Series D, E, pre-IPO rounds, then you're talking about restricted stock units, very similar to restricted stock awards, but they're a little easier to administer if you have sort of the plumbing built in at your company, where you have all of the payroll set up, all of the HR set up, all of the equity management set up, and they're a much easier path to get to public company land. Public investors are much more comfortable with this type of equity if you're giving it to employees right when you IPO. So that's one of the reasons people tend to use restricted stock units when they're about to IPO.
One last question for you, Neil, on this page, and then Ryan might have a few others from people. But what is the difference, if any, between preferred stock and founder preferred? Because I think those can be confusing terms.
So preferred stock, it'll be an investor saying, hey, I'll give you $5 million and I'll have a liquidation preference on it. If you sell for less than 5 million, or if you sell, no matter what you sell for, I get my 5 million back, period. Founder preferred is very similar. It has a preference. It is something a founder pays for, but the company is worthless when you buy it. So it's also very cheap. But the benefit is that you can sell that founder preferred to an investor, and you can get some liquidity out of it early. And so think of it as just like a special version of a founder's stock that you can get, call it founder preferred. And if you need liquidity early, you can get it. The reason that it's not very common is that investors don't want to see that a founder wants early liquidity, right? If an investor is investing in you at the seed stage and you have founder preferred, it can be an awkward conversation because founder preferred signals that like, hey, you want to take some money off the table earlier than most other founders do, which can be sort of uncomfortable.
Yeah, no, totally. And as a founder, I'll say I've had that occur where people ask, are you taking money off the table in this round? And every time, if I say no, they are excited. And if I say yes, they usually want to know why and how much. And if you want to take off a lot off the table, then it really worries investors because they say, well, wait, if I'm putting all this money in and the founders removing or reducing their ownership stake by a lot, what does that say? Going back to your point about information asymmetry, what information does the founder have that makes them want to go sell when I'm buying in? Am I the dumb money coming in later that doesn't have any of the information? And so that's always a risk.
Yeah, exactly. Like if you're shooting in the dark and you're sort of believing a dream that a founder is pitching you, say at the seed stage, and turns out this founder also says like, hey, of the 10 million you're going to invest, I'm going to take 2 personally and just keep it for myself. That is not a message that an investor is going to be very comfortable with. And so that is sort of the idea that you're getting behind is founder preferred. People do it, but typically it's going to be repeat founders or founders that are very comfortable with these like nuances of equity, not sort of first time founders or the typical VC founder.
So we have a ton of questions here in the chat. I think some of these will be answered as we get further into the presentation here. So I'm going to put a pause on some of those questions, but 2 that are like really, really quick here. My good friend Thomas Wade is asking, are preferred shares voting shares as it relates to control?
That can change. I think in what we've seen at Pulley, it is sort of all over the place. Some people do have them voting, some people don't have them voting, and it depends on how you phrase what you can actually vote on. But for the most part, yes, investors will get to vote on material changes in the business, such as if you want to IPO, they'll have to vote on it. If you want to do an M&A merger, if you want to sell yourself through a merger acquisition, or you want to buy another company, they'll probably have to vote on it too.
Another question here, Adam, was there anything you wanted to jump in?
Well, one sort of question to add that people might be thinking about too is you hear a lot about bigger, really successful companies, obviously Airbnb, Facebook, Google, and a bunch of others where they have special classes of voting shares, special classes basically that give every share that a founder owns, let's say 10x the voting power, which gives them sort of super control. How does that usually work? When do you see that happen in companies, and when should founders think about either think about putting that in place or not even consider it because it's also could be a negative signal unless you are like a rocket ship, like an Airbnb or something.
Yep. It's also a really good question. So the way it typically works is the default is that every share gets one vote, but you can decide how many votes each share gets, sort of however you want. And so what some clever lawyers have come up with is this thing called like dual class stock. So you'll have common stock that has one vote, and then you'll have like class A common or class B common that has 10 votes for every one share. And you'll give a bunch of those shares to a founder. And so the founder effectively has control for a very, very long time. They may own 10% of the company, but they'll own 60% of the votes. And so they can make themselves CEO, they can do whatever they want. And it used to be more common when you had these sort of super unicorns like or Snapchat when they were growing like crazy, Facebook, et cetera, Airbnb. It is much less common now, partly because of a lot of institutional decisions. Like if you want to be in the S&P 500, you can't have dual class stock. That's why Square is not in the S&P 500 because they have Jack Dorsey has super voting shares, and it is probably something not even worth entertaining unless you are sort of one of these crazy super unicorns where you have a lot of leverage as a founder. If you don't, then a lot of what an investor is buying at the end of the day over time is going to be it's not going to be worth it for them if they know that you're always going to be in control as a founder. A good example is say an investor is investing at your Series A, and then they're also so interested in your company, they're investing in the B and C and D, and they also want a board seat. If you have total control of your company, you can always just kick them off the board, vote them out. You can prevent them from getting a board seat. You can sort of dictate however you want it to look like. And that is not a very comfortable place for an investor that really wants to help you influence the business in a particular direction.
Yep, all good points. So one question here from David, and he's asking about warrants. Are they something to consider? Why or why not? And the I guess context here is Founder Institute's equity mechanism for our program is a 4% warrant that is then shared with the founders, mentors, and leaders of the program. And so we call it the equity collective, but it's equity sharing through a warrant. And so what are the common use cases you see for warrants?
Yeah, so if you can think of warrants as pretty much like stock options for investors. It's just a different name for it. It works very similarly. They can either be preferred warrants or common warrants. We've seen both. But basically, the investor gets the opportunity to buy whichever type of stock they agreed to buy at some point in the future for the price that they set today, or a different price they set in the future. And so it's mostly just more optionality for an investor. Investors tend to like it because they just get more time to make a decision. And so if you have, say, an investor invests in your Series A, they give you $5 million in cash and they get a bunch of shares, but they also get some warrants. And say the warrants they can use the warrants anytime in the next 2 years. That gives them 2 years to decide if the company is worth their investment, and they can continue buying. And if they decide it is, if the company's trajectory looks pretty bad, they can decide not to exercise those warrants, and they don't lose anything. So it adds a bunch of optionality for investors. Great for investors. And really, that's the negotiation. It typically happens when investors are less comfortable about valuation. And so at the earlier stage, it is really hard to value a company correctly because there's just no information. There's barely a product, there's barely revenue. And so warrants are useful in that sense because you're just working in a black box. So it adds more comfort on everyone's side. Ironically, they're probably more common in the later stage when your checks are bigger. So if you're in the early stage, you're investing a couple million, most people aren't going to want warrants on that. But if you're investing $500 million or $1 billion in a company that's a really fast growing startup, then you may want to add some warrants to sort of cover yourself a little bit better.
Awesome, thank you. So let's keep going to the next slide, and then we'll get to these other questions after.
Awesome. So a bunch of things here that are important, and I realize you guys here, I'm blocking things. We've talked about some of these, right? I'm like, why is equity important? Well, you need to understand how do you maximize your return at exit and negotiate with investors. And kind of the key idea around maximizing your return is what we talked about when we started, which is how much of your company are you willing to give up to achieve the growth rate and sort of exit velocity and value velocity that you want to have, that is the value that you expect the company to be. So if you take on $100 million today, can you use that money to get you to a multi-billion-dollar valuation? Or when is the right period to do that? And how much do you have to give up to get to that point? And so understanding that's really important. And also around like hiring employees is also really critical, and how you use your equity to do that. And we have some more slides to talk in depth about this, but at a high level, the core ideas around when you're a startup, you don't have that much cash. You are equity rich, however. You have lots of equity. And of course, you give out equity to your employees, you're diluting yourself as founder. But once again, just like taking cash from an investor, hiring a new employee helps you grow the company. And so you kind of need both the cash from investors, which you give up equity for, and giving out equity to employees to entice them to take lower cash from you, which cash is essentially like risk-free, and take equity instead, which has a much higher risk profile to it, but also greater reward. So early employees, if they take equity that's valued at pennies on the dollar, in your next, because you haven't even raised any money, your next fundraising round might make the company worth a few $1 million or multi-millions of dollars. And suddenly their equity has multiplied in value by multiples. And that becomes really valuable for them overall. And so it's worth their risk reward, even if the exit timeline is still probably pretty far off, especially at the early stage. How you split equity with co-founders is always a debate and a question that comes up a lot with people that I advise. The short version is it's probably not great to do a 50-50 split if it's just you and the founder, you and a co-founder starting. You want someone to have the final say. So even if you do 51-49%, that's a much smarter way to go, just so that there is at least one person who truly has the say. In many cases, of course, it is the CEO who has greater ownership, but not always, right? You might decide the CEO should be, let's say, the business co-founder, even if the idea for the company originated with the technical co-founder. In some cases, like the CEO doesn't necessarily mean the person who owns most of the equity. It's the person, hopefully, who's the right person to really be the chief executive officer, not necessarily the one who is the largest owner, for a variety of reasons, right? Owners, sometimes the owner might have, the first founder might have started the company earlier, so they have a larger ownership percentage. Then some other key terms that are really important relate to acceleration of the equity and vesting of that equity. And once again, some more slides about this, but in a sense, like acceleration is, does your vesting essentially accelerate if certain things occur, such as if you're acquired as a company? And of course, a vesting schedule is standard would be over X years of time. And I've a slide that goes in depth on this, but over X years of time, you receive a small percentage of your equity over every single month over, let's say, 4 years, is sort of what that means. I'll pause there. This is a little bit more high level, but I'll pause there, see if there's any key questions.
Yeah, there definitely are. It's around, there's some around like the percentages of equity. There's some valuation questions here. What I would recommend, let's go to the next slide, and then after that, let's power through some of these questions.
Yep, absolutely. So Neil, this is you.
Yep. So I think I mentioned this earlier, but one of the themes that you're going to see with equity a lot is all about taxes. And so the question we often get at Pulley is like, oh, it's equity. Like, why do I owe taxes for it? It's not sort of my income. But I think one thing to keep in mind is that if you're working for your equity, so you're a founder and you've bought your equity, you're getting it, you're vesting it over time, or you're an employee, and part of your compensation is an equity, then you do owe taxes to the government based on the equity. And so a lot of what you're going to see about equity and compliance and all this other stuff is designed to help you save on taxes. And so all the differences that we talked about, stock options versus restricted stock, or common stock versus preferred, a lot of those could boil down to sort of differences in taxes for the particular people involved. And the first thing if you don't take anything away from this presentation at all, the one thing you should is that please file your A3B elections. So the A3B election is this tax form that you file with the IRS if you're paying US taxes, that says, hey, even though I'm vesting over time, and normally I would pay taxes every time I vested. So you can imagine how this is horrible, right? You're vesting over 4 years and you vest monthly over 4 years, which means normally you would have to pay taxes every single month as the price of your company goes up. So your taxes will continue to go up. It's a nightmare scenario. And so the solution to that is you can file this very simple form that says, hey, I want to be taxed today on everything, even if it's unvested, just tax me today. And the benefit of that is when you're a founder, your stock is almost worthless. It's going to be worth like, you know, a hundredth of a cent or a thousandth of a cent or something crazy like that. And so you're effectively paying nothing because your stock is just worth nothing. And so you can get this out of the way, pay your taxes today, and you don't have to worry about it ever again, which is awesome. And it'll absolutely minimize your taxes in the long run. And we can talk about where employees fit into this picture as well, but probably the number one thing you have to remember after incorporation, get this form filed. The next point is called qualified small business stock. It's just another tax savings you can have if you are a founder of a company. There's a ton of restrictions here, and it really only applies at exit, but it's something like you have to hold it for 5 years. It has to be worth less than $50 million. It's a very niche scenario in which you'd be able to use this, but the benefit is huge. You don't pay any income tax when you sell your stock. So something to keep in mind if you're getting sort of acqui-hired or something like that, where the exit value for business isn't crazy high and you've been at it for a while. Something to keep in mind, something to keep on the radar to look into as you exit. And the last thing, it's not so much equity related, but something that's equally important with taxes in this whole big picture is IP assignment. And so when you go join a company, one of the sort of key HR pieces of paperwork that you make everyone sign is called an invention assignment agreement, which basically says, hey, no matter what we invent or discover or figure out at this company, it's all owned by the company, which is super, super important when you go to sell your company. If a big other company decides to buy your company, and part of the reason they're buying it is because the technology you've developed, you don't want this lingering risk that, you know, somebody didn't sign this agreement and they could potentially sue and say, hey, the IP is actually mine. And this goes back to the point about economics. This is a classic case of somebody giving you less money at exit because you screwed up. And that's something we absolutely want to avoid.
Yeah. And I'll just say for both 83B and IP assignment, we've seen at AbstractOps multiple companies that mess this up. So employees don't get their 83B election when they should, in which case they miss the window when they can actually file for it, which is incredibly painful. And you just don't want to put your employees in that situation. It's almost malpractice, I think, for founders to let this expire and their employees can take advantage. Or once again, even yourself as a founder, you'll really regret it long term. And IP as well. It's one of those documents that, because founders don't have to execute, essentially also sign the IP assignment agreement, it's only executed and signed by the employee. It's something that founders miss a lot. And hopefully your lawyers at some point will catch that and hopefully fix it before you go public or get acquired. But if they don't, you really do hurt your overall return profile.
Yep.
So
you want to pause go ahead.
Yeah. I actually have a question for the qualified small business stock. So that's like one of the best perks for an exited founder to prevent capital gains. We actually had a Founder Institute company just exit. I won't disclose the name, but the founder is walking away with like tens of millions of dollars in cash. And so does he have to invest that $10 million directly into other companies to realize the I think it was a Section 1202 capital gains clause where he doesn't pay taxes on that 10 million?
Yeah, it'll depend on sort of the facts, the other facts surrounding it, but generally no. You can get away without doing that. There may be some other taxes layered on if you don't do that. There's a lot of alternative minimum tax rules, things like that could apply. Basically, the IRS wants to make sure they're getting some money, even if they have really cool exceptions for you. And so there are certain cases where he could get away with paying nothing if he invests that money. There are many cases where he will still have to pay a small amount of tax if he wants to keep it.
So I'm going to just power through some questions here because we've got quite a list. So Travis, you asked one of the most original or first questions here. So Travis has a social benefit corporation. It's an S Corp. It's a design firm, and it owns 2 subsidiary LLCs. When speaking to investors, they're discouraged because they can't invest in the S Corp. He says that he's not going to transition the S Corp to a C Corp. So do you have any advice on how to talk an investor away from investing in the S Corp into the LLC? So this is a common thing we see with founders. Do you want to shed some light here?
Yeah, S Corps are challenging for investors because a lot of the restrictions on maintaining your S Corp status and getting those tax benefits go away if you have investors invest. There's a bunch of tax rules, but I think unfortunately, the one most of the times I've seen this is requires a flip to a C corp at some point. This is mostly a lawyer question, though. There's definitely creative things you can do to get around it, but I would ask a tax lawyer to confirm.
Adam, as an investor, right, putting your investor hat on, would you ever invest in an S corp or in an LLC that doesn't own the IP?
I mean, the simple answer is yes, but when it comes to the valuation, it's a discount on the valuation because it's more challenging for all the reasons that we've just discussed to get to own the right to really own the pieces that you want and realize the overall value. So you'd have to put a discount on that sort of entity.
So another question here. This is surrounding IP. Yashaswini, you're asking, how is a startup without IP valuated? We actually have a lot of valuation questions here. So let's just have a conversation around valuation. So in this particular one, she's saying there's no IP. Another couple questions, they're just asking how is valuation determined? So Neil, let's start with you. How is a company valuated?
Yeah, if you're talking like early stage where you don't have really a product or much IP or anything like that, it's really going to be based on comparables to other similar companies in your space and what they've raised at when they were at whatever stage you were at. So, if you want to make like a calendar company, and people are going to look at like what did Calendly raise at, and at what metrics did Calendly do it, and so they'll apply that to whatever you're doing. And so it's really more art than science at the early stage. It'll be what are other companies like you doing? What do they raise at? And also like what is the current market adjustment for that? Like, today valuations are much higher than they used to be 10 years ago. And so even if you're doing the same thing that another company did 10 years ago, you're going to get a higher valuation today, partly inflation, partly just because the market has adjusted to that. But that's really the long story short of it is it's people are going to use similar companies, similar growth profiles to figure out where you land.
And I want to add as well that people sometimes think about IP and think immediately go to patents or things like that. That's not actually the right way to think of it. So you even if you don't have patents or patent filed, that's not in many cases what people think of when it comes to IP. At least I don't as an investor. Especially because patents, like I actually I don't discount patents, but I don't think in most cases they're all that valuable. In fact, from an investment standpoint, in fact, what you think about more when it comes to intellectual property is around how something is being run, how it's been built, how it's been put together. In many cases, you might not even want to file a patent around it because you don't want it in the public sphere, but you don't want an employee running off and recreating everything that you did as a business that might be in their head because they have this IP agreement to protect them. So just to be clear, it's not owning IP does not necessarily mean I have a patent or patent in process.
So another question here. This is, well, Tamar, you have a couple questions. You're asking if you can file an 83B if you're an LLC.
Yes, you can. The 83B depends on the type of security you're getting. Anything that vests in the future, so anything that's subject to vesting that you don't sort of own in entirety today, that is equity that can be taxed on, can qualify for 83B.
And then your second question is, how do you decide how many shares the company owns as a single founder with no funding yet? So maybe, I don't know if you want to talk about like authorized shares versus issued shares and what that structure looks like.
Yeah, so the standard will be 10 million authorized shares. Authorized and so the distinction that Ryan mentioned is that there's things called authorized shares, which is call it your cap on how many shares your company can issue. And this is something you can change pretty much whenever you want. It's just a bunch of paperwork that's sort of annoying, but it's just the absolute cap that you can do at the time. And this cap changes, of course, as you get investors and things like that. And then there's the shares that your company actually issues. So as a founder, the shares you're buying. And the question is, how do I know what number that should be? The standard and what I would default to is 10 million authorized shares. And it really doesn't matter how many you give yourself if you're the first person owning equity. The challenge comes in calculating the percentages that other people will get after you. But the default is just give yourself 10 million. and just stick with that. It's the easiest thing to do. I think most incorporation services and most lawyers will stick to that as well. And so if there's like 2 founders, each get 5 million, something like that, depending on how you want to split it up.
So I'm going to combine 2 questions here because I want to get back to the presentation. So what is an acceptable founder salary in the early stage? And then how do you suggest compensating early stage employees who maybe can't work full-time yet on the startup?
Yeah, so it's a really tough question about what is an acceptable, cash compensation, right? It really depends on the business, how much you've raised, how far along you are. If you're really early stages and you've only raised $100,000, maybe as a founder, and especially because you as a founder will own a large majority of the company, 100% of that cash should go towards either buying, let's say, services on AWS or other services that you might need to build a company, or even paying some minimal money out to contractors or employees. And so your salary is 0. Or you reach a point, and you probably have heard this sort of like, ramen amount where you're getting like enough to like afford your rent and like buy ramen every night to eat. And you're just barely enough to get by, is maybe the next step. And then as you get to different levels, you can pay yourself more depending on what you've raised, and what makes sense. And so we have companies at AbstractOps, everything from really the earliest stages all the way through Series C. And in many cases, you see their salaries go up over time, and to the point where some of them are getting paid close to what they were making at their old companies. And you might be making a lot of money if you're a senior engineer from some of the big tech companies, and you might be paying yourself a similar amount. And guess what? Your investors should be happy about that because you are presumably absolutely worth it. And that's why they gave you at that later stage all of that money as well. So that was a question around the compensation. What was the second part about equity?
Yeah, it was about basically like, how do you incentivize, or what's the structure for like part-time workers in the very beginning of your startup?
Yeah, totally. So the structure for part-time workers, once again, comes down to their own risk reward profile and what they are willing to take and do. So in other words, and this goes the same for employees, right? So there is a trade-off between cash and equity. And actually at AbstractOps, we offer, and we actually recommend other people do this too, we give every single person we hire 3 choices for compensation. Choice 1 is higher cash and lower equity. The second choice is middle cash and middle equity. And the third choice is lower cash and higher equity. And it really depends on their own risk reward profile, what's happening in their personal lives. And that's a question you should just talk through with your contractors or employees. Do they need more cash to get by? Or do they want to take more of a bet on equity because they really believe you as a founder, or they believe in the vision of the company and where it's going to go? And it just depends. What sort of risk are they willing to take?
Yeah, and Adam, I think the one way that what we do it actually internally at Pulley is that we use a benchmarking tool. And so there's tools like Pave or Option Impact or OpenComp. And we recommend just setting internal guidelines for how you want to do it for employees. So at Pulley, we do 50th percentile in cash. I forgot what the percentile for equity, but there's another percentile in equity. And we adjust that up and down for the 3 things you talked about. So cash heavy versus equity heavy versus a balanced package. And that way you sort of ground yourself in your employees ask you questions like, how do you get at this number? And you can be like, oh, for your geography, for the role we have and for how much money we've raised, this is sort of this percentile that we're aiming for, which is a much easier conversation to have than, hey, I shot in the dark and figured out a number.
Correct.
So let's keep going with the presentation because we only have about 10 minutes left. We may have to do 2 of these, Adam.
No worries. I know this is a deep topic, but we'll keep going here. Investor equity, and we can try to go through this sort of quickly. We'll have more about investor discussions in another course. But look, at a high level, how much you should raise is once again a function of how much you need to prove and how expensive your industry is. So if you need to hire a huge number of engineers and you need to go build your own servers instead of going on AWS, maybe you need to instead actually raise a massive amount of money to even get there, or it's like really deep tech and it's just expensive to go build, or you're actually like building the next rocket or something. Well, building rockets is expensive. It just is to get to that next level. So it really depends on your business. With that said, I'd always be really careful about not over raising, but also not under raising. And so I know that's still a hard benchmark to put in place, but essentially, if you start getting to be a hot company, investors will start throwing money your direction. And it can feel really nice to have people want to give you money and believe in your vision. but I would be careful about over raising, because when you over raise, it leads to the second point, which is you are over diluting yourself. And by dilution, what that essentially means is you are giving up the benchmark that most companies look for in every round is about 15 to 20% that you will essentially sell of your company to get the cash from investors. Now, once again, that cash gets invested to help you grow so that the overall value, essentially the size of the pie of your company, goes up in value between 12 to 24 months after you take that cash. So it is a trade-off, but if you're giving up 20, 30, 40% of your company in every round, at some point, you and the other employees really own a tiny, tiny percentage. You've been diluted to the point where you might even question whether it's worth continuing pouring your blood, sweat, and tears into that startup. The question on what investors get when they invest, we've talked a little bit about this, but right, they are usually getting a SAFE, which is a simple agreement for future equity, which converts at a later point. We've already talked about preferred stocks. They also get a preferred stock when it converts. We can talk more about SAFEs and what that means as well. But and then key terms to understand are like pre-money versus post-money. So pre-money would be essentially, I'm setting the price at 10 million, and that's the price right now. And then when I go raise 5 million, my company now is worth essentially 15. The sort of post-money valuation is 15. Or post-money, you can set it and say like my valuation is 15. And every amount that I raise, it almost dilutes me a little bit more. And some are better than, there are pros and cons to both pre and post money in what you do. There's also terms like pro rata rights. So usually founders don't get any of that, and a lot of investors don't get it, actually pro rata rights, but usually your larger investors do have pro rata rights. Even if, this, by the way, has nothing to do with preferred or not preferred shares or common shares, but the pro rata rights come into play when they are able to continue with their ownership, essentially ownership percentage as the company goes up. So if you want to sort of protect how much you own of the company as an investor, and many investors want to own 10 to 20% of your company at every round. So you might have different investors at each round, but they each want to own 10 to 20%. And then they'll get pro rata rights, which means they can essentially protect a lot of that ownership percentage as they continue to grow, as you continue to grow and do subsequent rounds. And then there's also option pool. I'm going to skip liquidation preferences just for time purposes, but your option pool is essentially what you set aside in every round to give to your employees. So you might, let's say you set a 10% option pool. You then hire 10 employees and you give each employee 1%. You've now used up all of your option pool. And then you will actually need to increase it if you hire an 11th employee. And what ends up happening there, of course, is as you have to do a board document, have the board approve that you are going to increase your option pool. The problem with increasing your option pool is that it actually dilutes all your other investors, including all your employees. So there is a trade-off between doing that, which is why you want to be careful with how much equity you give out, how big your pool is, and then how much equity you're giving out. And you want to make sure your pool is the right sort of size for every round as well, because you don't really want to go back to your board to increase your pool later, because they might say, wait, you've given out too much equity. We only agreed that you could give out 10 to 15% of your equity to your employees in this round, and you've used up all of that. Maybe you're not being good stewards of the equity that you have, and that may make investors question you as a founder. So I'll pause there. There are probably a bunch of questions there, but I'll pause really quick, Ryan, or we can go to the next slide.
Yeah, let's go to the next slide because we only have 6 minutes.
Yeah, totally. So quickly going through this one as well. Look, risk reward profile. We talked about this a bunch as a key idea. Is at different stages of the company, you will hire people who have different risk reward profiles. As you get to be a later, bigger company, you'll hire people who are willing to, they want more cash or they want more equity that has a more guaranteed value, right? When you're an early company, you might say your company's worth 20 million, but no one really knows if it's worth 20 million. When you're about to go public, it's pretty clear you're at least worth what the amount is that you're going to go public at, if not, frankly, a lot more, because of course you're hoping for a nice bump in valuation when you go public. So it really is that risk reward, and the people you hire differ depending on that. And you might have to give people a lot more equity, right? You're not going to give, if Airbnb hires a new senior executive today, they won't give them 1% of the company, nor would that executive expect it, because that equity is now worth so much. So it's really a conversation to have. Another thing as well is giving that equity to employees. You want to make sure you do it as soon as possible once they join, for a lot of the reasons we've discussed before with taxes, but also you just don't want to wait. It's just bad practice. If this is something that's part of their compensation and you wait to essentially grant them the equity, that sort of brings into question how you're managing the business overall. So you want to do it the right way. We already talked about the option pool and compensation plan. So I'll go on from there. There's one more slide related to this that I think is interesting. One thing that we actually do, and going back to the vesting schedule question, at AbstractOps, we actually, so a standard vesting schedule that you should put in place for everybody at minimum is a 4-year vest. What that essentially means is there is a 1-year cliff in most cases. And a cliff means that an employee has to stay at the company for at least a year to essentially get their first quarter, so 25% of their 4-year vest. So if they were given a 1% grant, they own 1% of the company when they got that grant, they will get 25% of that every year. So 25 basis points over 4 years, but they have to wait for a full year before they hit that cliff to receive that first year's worth of equity. After that, they will then vest essentially 1/48th for the remaining 36 months of that vesting schedule. So every month they vest another sort of bit of their equity. With that said, what we really recommend is as companies, as you hire senior people, you might want to put them on a 5-year vest, what I would call the kind of 5-year double. So you give them 2 grants. One starts when they start, the second one starts in year 2. And then it kind of gives them this nice distribution. So in the middle, when they're really producing a lot for the company, they have both of their grants vesting. The same thing with the 6-year triple, what I call it. And it's actually what we do at AbstractOps. So the founding team at AbstractOps is on a 6-year grant schedule. And I have 3 different equity grants essentially, which means that by year 3, when my 3rd one kicks in, all 3 of my grants will be vesting at the same time. And I will hopefully be producing at the highest level possible at that time, because that's when I know the most about the company. We're really starting to take off. The reason this is also valuable is because with early stage companies, if it's just you and a co-founder and you're both on a 4-year vest schedule, it can take a year or 2 before you even really start to hit the ground running, right? It might just be you 2 in a garage for the first year or 2 years. And now let's say 2 years in, you realize your co-founder isn't the right fit for the company. It's not working out. You guys aren't as good a match as you expect. They've now walked away with a really large percent ownership of the company. That's really, really, really dangerous. And you'll have to do a lot of things to either buy that equity back. You name it. It just is not an ideal situation to be in. You want to give people the equity that helps incentivize them to work at their best level without hurting the company at the same time. So I'll pause there. I think we may have like one more slide, 1 or 2 more slides at most. Actually, basically 1 more slide, and then we can go from there.
Okay, sounds good. Yeah, I just want to do a quick time check because we're 2 minutes to the top of the hour. We scheduled this for an hour. I can keep going. Adam, Neil, I don't know if you have a hard stop, but.
Nope, I just double checked my calendar. I can keep going a little bit too.
All right,
same here.
All right, let's extend this for 10 minutes. We still have a ton of people here. We'll push the networking piece out by 10 minutes. So why don't we keep going with the presentation and we'll do some final questions.
Great.
Cool. I'll take this one. So employee equity terms. So there's a lot of, there's probably a handful of decisions you'll have to make as a founder with respect to your employee equity. And the first one that I think we previewed at the beginning of the call is what type of equity you're giving them. So stock options or restricted stock awards. And the simple answer is that it's way, way easier to administer stock options than restricted stock awards. The reason is that restricted stock awards require their employees file an A3B. And remember how even today, founders still mess up filing their A3B elections. Imagine doing that for every single employee you hire. So, and you can't file this for them. They have to mail it in person to the IRS. They have to sign in wet ink. It's a huge, painful process. And so that's generally why we typically don't see restricted stock awards for employees at the early stage, unless the founder is willing to take on the sort of administrative hassle of making sure everyone has filed this thing with the IRS. And then as you get to the real answer, as you get to the later stage, is that stock options are free. You can give them out until the employee actually uses them. They don't pay anything. So if the employee stays for 2 years and they don't want to use their options, they don't lose any money. Restricted stock, you have to buy when you get it. And so if your company is worth like $10 a share and you're giving a person 100,000 shares. That's a lot of money to give you up front for no guarantee that it's going to pay off in the future. And so generally, once you hit sort of a couple of cents per share, you're going to stick to stock options going forward. Exercising early. This is probably the second big feature that you have to decide on, particularly with the stock options. And all this means is that whether you can exercise or use unvested options. So normally you can only buy options that are vested. And so you vest over 4 years, you can buy more options or you buy more stock monthly using your options. And that's typically how it would work. Early exercising lets you buy no matter what your vesting looks like. The benefit is that employees can save some on taxes because they'll get to buy the stock, today when the stock price is currently low. The downside is that it adds a little bit more of an administrative headache for you. The main difference between stock options and restricted stock for an employee is that if you leave the company and you own options, you have to decide to buy them. It's all on you, all on the employee's end, totally an employee decision. If you have restricted stock in your employee and you leave the company has to buy back your stock from you. And so it can be a huge pain to figure out the payment method for this employee, figure out where if you need to mail a check, where are they living, you have to make sure they're okay with it and they get the notice and all this other stuff. And it's just it becomes a huge headache and something that's easily messed up because there's a period of time you have to do all of these things. And if you miss that period of time, you're sort of screwed. And so early exercising is generally more employer favorable, but can lead to some administrative headaches in the future. Also plug for tools like Pulley or any other cap table tool, honestly. That is what these tools are designed around, is preventing you from messing these sort of easy to mess up things about equity. And then the final decision you have to make is post-termination exercise. So like I mentioned earlier, if an employee leaves a company, how long do they have before they have to do anything? And the big difference, the two big ones you're going to see, definitely more commonly to see 3 months, but the two big ones are 3 months or 10 years. And the idea is that an employee has to pay cash to use their options to buy stock in your company. And that could get really expensive if you have a really late stage company. And employees may not actually have all the cash they need within 3 months to buy your stock. Like if I have to pay $100,000 to use my options, I may not have $100,000 in cash just sitting around within 3 months after I leave my job and I'm not getting paid anymore. And that is really shitty for employees. It's not something it's really unfair to them in many respects. And that's why some people do the 10-year version, where you give employees 10 years to gather the cash they need. The downside is that if you do 10 years, you're basically holding your option pool hostage with these employees who don't work for you anymore. They're still part of the pool. They still get to hold options, but they're not working. They don't contribute to the success of the business anymore. So it's a bit unfair to everyone who's still at the company. And then 3 months, point I mentioned earlier, employees strapped for cash, it leaves them in a really bad situation. The sort of silver lining is that you can adjust these periods on a per person basis. There's a really special employee who's going to start his own company. You're really excited about him. He was a great employee, but just doesn't have the cash to pay. You can extend that window however much you need to on specific cases, but it does require more paperwork.
The other challenge really quickly, and we've unfortunately seen this happen a bunch with folks, is even if you do exercise your options and purchase them, you also owe taxes on them. And that's really painful. I mean, it shouldn't be, but it could be many years until that company has an exit still. And so you're not actually going to realize the return, even though you have to pay taxes on it today. It's even more problematic and terrible if the company somehow has a failure or the value that they go public for, get purchased for, is lower than what the actual price was. You still have to pay taxes at what the price was at the time. And so it can be incredibly painful from a tax perspective and cash upfront perspective to actually purchase that equity. So I will go to this last slide really quick. Basically fundraising, right? Like as startups, you're kind of always in fundraising mode. In a sense, you want to always keep raising. You're going to need to do things such as a 409A valuation, which helps you understand and helps everyone understand what the sort of actual value is of that stock. At the same time, the valuation that you get from a 409A, and I know we can go deeper on that too, but the valuation that you get on a 409A is probably different than what the value at which you might give out your equity to your employees, especially as part of their compensation. The challenges in how you explain that to your employees is really important. So the 409A is sort of what there's a bunch of different ways, and Neil could probably go into depth on how 409As work, but the companies that do this will end up looking at a lot of different comps and try to figure out what that valuation is, which, by the way, the 409A valuation is different than the sort of future valuation that investors might have put on the company, where they say, okay, I'm investing at a $50 million valuation, but that's really a future look. That's what they think this could be worth if you keep building things out the way they expect, and how things go. So there's a sort of constant push and pull between future value, current value, and what you're looking for over time. And then what investors in the future will look for as well. You don't want to overraise, because you also want to make sure you can hit usually doubling or more of your valuation every 12 to 18 months, because it is sort of this constant hamster wheel in a sense to keep raising, but you need the cash once again to keep growing. And growth is really what people want to buy as you build a amazing new business that's going to hopefully change the world. The other key thing here as well relates to how you describe the value of the equity to your employees. One thing you could discuss certainly is the 409A valuation, which is the price that they would pay to sort of purchase that stock, or the option strike price that might be on it. On the other hand, the value that's sort of from a compensation perspective, you might want to talk about, like, this is the target value of the equity, or if we were to exit today, we think your stock is worth this much. So they can help the employee have a clearer understanding of what your overall compensation package is, right? You're getting 100,000 in cash, and you're getting 10,000 options or shares. And this is the target value of what those look like. So your total compensation, in theory, if we were to exit today, would be around this price. So those are all the slides. We can stay on for questions. Ryan, you tell us what you want to do. We're happy to stick around.
Awesome. Well, look, there's a really important question here that I want to ask, and then we'll wrap up. But just before we do that, I just want to thank everyone for joining today. We've got a lot of great questions. We will be sending out a copy of this webinar over an email in the next few days. And for founders that are interested in being backed by one of the top pre-seed accelerators in the world, you can go to visit fi.co/join to apply to the closest program near you. So the last question here before we wrap up, and this is important, this comes from Simon Roca. What contractual agreement would equity distributions be in? Can early founders create or use a template, or are lawyers recommended for these agreements?
Yeah, I can take that one. So there's definitely an agreement. It's called, it'll be typically called like a stock purchase agreement or a restricted stock purchase agreement. And you can find templates. So whichever incorporation service you used will definitely have templates. So Stripe, Atlas, Clerky, whatever that looks like for you. Your cap table management solution should also have templates available if you're at that stage where you're on a tool like that, or your lawyers will have templates for you too. And so whichever tool you're using to manage equity, whether it's lawyers, whether it's a service, or do incorporation, all of those will have templates prepared for you that you can just plug in your name in, and they'll help you figure out a few key terms to like decide on, and then you're good to go.
Anything from you, Adam?
No, I covered it.
Adam, Neil, thanks so much. We're going to go ahead and transition to the networking part of the session. We just pasted the link here in the chat, and I hope everyone here got a lot of value. I certainly did. So Adam, thanks once again, and I'll see you soon. Neil, it was great to have you as well.
Thank you all for being on. We really appreciate it. Hope this was helpful. Have a great day.